Here's something nobody tells you about being poor. The less money you have, the more expensive everything becomes. Banks literally charge you higher interest rates because you're broke, which makes it even harder for you to stop being broke. And the worst part? This isn't a bug in the system. It's a feature designed to keep you trapped. Today, I'm going to show you exactly how this trap works and what we could do to fix it. Let's get into it. So here's the fundamental problem with debt in our society. When you don't have money, everyone tells you the solution is to borrow it. Need a car to get to work? Take out a loan. Need an education? Borrow for tuition. Short on rent this month? Put it on a credit card. But once you enter the debt system, you're not just paying for what you needed anymore. You're paying extra for the privilege of being poor. Every loan comes with interest, and if you didn't have the money to pay up front, you definitely don't have the money to absorb high interest payments on top of it. And here's where it gets really twisted. The less money you have, the riskier banks consider you. So they charge you even higher interest rates than they charge wealthy people for the exact same loan. You were already struggling to afford one expense. Now you're struggling to afford that expense plus compounding interest. Your hard-earned money isn't just covering your needs anymore. It's funding someone else's profits month after month. This is the debt trap, and millions of people are stuck in it right now. Now let's talk about credit cards, because this is where the system gets truly predatory. Credit cards are sold to you as convenient and flexible, but they're really just debt machines designed to keep your balance unpaid. Here's how the scam works. Banks borrow money from the central bank at extremely low rates. Then they turn around and charge you 20% or more on your credit card balance. And those minimum payments? They're calculated specifically to keep your balance high, so you keep paying interest for years, sometimes decades. If you have a $5,000 balance and only make minimum payments, you could be paying it off for 15 years while spending thousands extra in interest. Then there are late fees, penalty rates, and hidden charges that kick in every time you make a mistake. Every misstep is another opportunity to squeeze more money from people who are already struggling. And here's the ultimate irony. If you have money, you don't need credit cards. But if you're poor, you need credit cards just to survive. That's exactly what the banks are counting on. They make their biggest profits off the people who can least afford to pay them. But the debt trap has evolved with technology, and now it's even more insidious. You can now finance literally anything: a phone, clothes, a vacation, even a meal at a restaurant. These buy now pay later schemes promise zero interest for a short period, but miss one payment and you're hit with massive penalties. Subscription models and installment plans ensure you're always paying for something. You never truly own anything outright. You're just constantly making payments. Instead of encouraging people to save up for purchases, the system pushes them to spend now and deal with consequences later. This ensures people will always be indebted to someone, forever trapped in the payment cycle. Now here's where the system reveals its true design: the credit score. Our financial system actively pushes people toward debt even when they don't need it. If you live within your means, avoid loans, and pay for everything in cash, your credit score stays low. But if you take on debt and make regular payments, your score goes up. This forces even financially responsible people to play the debt game just to qualify for mortgages or better terms. Credit cards make this worse with cashback offers and rewards, but these perks exist to lure you into carrying balances and paying interest. The real problem is that creditworthiness is tied to debt usage rather than actual financial health. The system doesn't evaluate your savings habits, your rent payment history, or your real-world spending discipline. It forces you to borrow just to prove you can manage debt, and that's completely backwards. So we've seen how the system is designed to trap people in debt, but it doesn't have to be this way. There are 3 major reforms that could fundamentally change this broken system. Let me break them down. The first reform is shifting debt from consumption to investment. Right now, personal loans for discretionary spending are easy to get, trapping people in high-interest debt cycles. What if we restricted access to personal loans by requiring stronger justifications and limiting high-interest personal credit? People would be encouraged to manage finances more sustainably instead of relying on easy debt for consumption. At the same time, we could make business loans more accessible with lower interest rates and streamlined approval processes. Government-backed lending for startups and small businesses would encourage wealth creation rather than consumer debt accumulation. This creates a cycle where people are incentivized to build productive enterprises instead of being buried under personal debt. The second reform is shifting from post-paid to prepaid wages. Why should low-income workers wait 2 weeks or a month to get paid for work they already did? This delay forces them into payday loans and credit cards just to survive until payday. Some companies already offer earned wage access, where workers can withdraw portions of their wages in real time. A hybrid model where employees get part of their wages up front and the rest at month end could balance worker needs with business cash flow. Governments could support this with tax incentives for early wage access or low-interest advances backed by employment verification. The third reform is reimagining how we measure creditworthiness. Instead of rewarding borrowing, credit scores should reflect true financial responsibility by evaluating savings habits first. A person who consistently saves should be seen as financially responsible, not someone who needs to borrow to prove themselves. The system should consider rent and utility payments, which many people make on time for years but don't count toward credit scores. We should also look at income-to-expense ratios, measuring financial health based on the ability to sustain lifestyle without relying on debt. This would remove the systemic push toward debt while still allowing responsible individuals to access financing when truly needed. It's a system based on actual financial stability, not on how much debt you can juggle. Look, not all debt is unreasonable. Some borrowing makes sense for essential assets like a home or car that you need for work. But the current system isn't designed to help people with reasonable borrowing for essential needs. It's designed to trap people in endless cycles of consumption debt that benefit banks and corporations at the expense of regular people. The 3 solutions I shared today, shifting debt toward investment, implementing prepaid wages, and measuring creditworthiness based on actual stability, these are common-sense reforms that would fundamentally change who benefits from our financial system. If this opened your eyes to how debt really works, smash that like button and subscribe for more content on systems that need to change. Drop a comment and tell me which solution would have the biggest impact. Thanks for watching.